Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we're back here on YouTube and it's time for another look at Bitcoin. We're going to be looking at the long term and the short term. Today we're going to be looking at multiple Elliott wave counts over those time frames. We're also going to be looking at cycle data as well. And we're just going to be doing a general all-round update. So we're going to start here on the BLX, the Bitcoin Liquid Index. First thing we're going to do is just get rid of the Elliott wave count for the long term, and we're going to bring up our market cycle using our bear markets and our bull markets and bear markets, and our seasons overlaid. So I tell you what, we'll leave the seasons off for a moment. So in case you're new to the channel and you haven't seen any of this before, there's a video you can go and watch from a fair while ago now called the Bitcoin Primer, and it will introduce you to in more detail this idea of a 4-year cycle. So I'm going from bottom to bottom on this cycle. Some people go from halving to halving. Although I think the halving data may be relevant, I don't think it's as relevant as some believe. I don't think it should be discounted, but I don't think it's how I like to look at the market. I prefer to look at the 4-year cycle as a liquidity cycle. But the halving data, we will go over that as well, because we don't know whether or not it's relevant, but it does provide an interesting way, an interesting metric for monitoring Bitcoin's performance over the 4-year period. We'll look at that in a little while, but either way, if we just work on the premise of our previous bull markets and bear markets, roughly 3 years of going up and then 1 year of going down, 3 years of going up, 1 year of going down, 3 years of going up, 1 year of going down, 3 years of going up, and then 1 year of going down, we are now approaching the end of the bullish phase of this 4-year cycle. Now I currently have this, if I look at the daily time frame, dated the 13th of October this year. 2025 is when we can expect the market to peak. It may peak earlier, it could peak tomorrow, it may peak later. This 4-year cycle may continue to play out, this 4-year cycle may break. We don't know any of that yet, but we will do as and when we have evidence for it. So we don't throw out the baby with the bathwater, and although there's a lot of talk around at the moment about how a 4-year cycle is dead, we don't know that. And nobody, in my opinion, should ever make statements of knowing. You know, we are all agnostic at the end of the day. We have to be by definition because we can't possibly know. Alright, you could be theistic if you want to, a Bitcoin theist, and just believe that the 4-year cycle is over. But you could be a Bitcoin atheist, I guess you could say, and not believe. So I would say let's speak to knowing and not knowing, which is Gnosticism and agnosticism. I am, by definition, have to be agnostic because I can't possibly know whether or not it's going to peak and collapse into another year bear market or not. What I do know is that it's done it every single time prior. So we're going to continue to observe that, keep the data on the chart, and if it changes, it changes. We can discuss about what that means, we can theorise about new ideas, but really it will just be a case of taking in the new data over the next 4 years, 8 years, 12 years, or maybe 5 years, 10 years, whatever it is. And we'll establish new patterns if they are present. But in the meantime, this is what we've got, this is what we're going to work with. So on that basis, we are very close to the finish line, right? We are still, in my opinion, lagging behind where we should be sentiment-wise. We're getting there. We've had a lot of institutional adoption. There is some hype coming in with the recent new all-time highs in Bitcoin. YouTube is lighting up a lot more. The media generally, legacy media, still generally, in my opinion, lagging behind. And the genuine euphoric hype, which tends to come, I would argue, is not yet present from retail, but I think it's coming, and I think it's coming very soon. I think the reason it's been lagging so much is because people just can't afford to be involved. This is down to obviously rates being kept so high for so long, business cycle being suppressed and not making as much money, and therefore we are not seeing, although Bitcoin's considered a safe asset relative to the rest of the crypto market, it is still out there on the risk curve for the average individual. And even though institutional investment has come in, I still believe the general consensus is towards it being a high risk asset. So we only tend to see participation in high risk markets when there's excess liquidity. Essentially people have more cash to spend and the market picks that up. I think that's all yet to come. This could be a strong argument as to why the 4-year cycle is not going to last and why it's going to extend this time, because rates are still yet to come down. We're expecting decline. We're expecting rates to be officially cut next month in September. We're still waiting to see bond yields climb across long-term bond ETFs and wait to see those yields drop and see the prices of these bond ETFs, I should say, prices recover and these yields come down. But it's still very much a sideways game. So all of that I'm expecting all of that to change in the coming months, but I don't know exactly when. So we'll have to wait and see. But either way, if the 4-year cycle plays out as it has done, we shall be topping out somewhere around October this year, and then we will endure another year-long bear market, and we will bottom somewhere around October the following year, October-November the following year, 2026. So we shall wait and see if this plays out. So there's your bull markets, your bear markets, 4-year cycle. We can also look at this via splitting it down into segments of spring, summer, autumn and winter. The winters obviously represent the bear markets. We can see now that we're well through spring and summer. We're now into the autumn, the last period of the season, or the last temperate season, I guess we could say, before the bear market winter. Now that we've looked at that, let's now have a look at the halving data I mentioned earlier. So I do not feel that the halving is as big a deal as many think it is. I used to be quite a strong proponent of it, but as the Bitcoin market has opened itself up to institutional investment, I think broader market liquidity is going to be a bigger driver of price action than the supply dynamics of Bitcoin. But either way, I do think it's relevant data, and it's and I do believe it's a very interesting metric for monitoring historical performance. So on that basis, if we look at what we've done via that historical performance, we can see that from the first halving, we saw that of all the post-halving gains, so basically we have the gain we make before the halving since the bottom of the bear market, the end of the winter, right, and the beginning of spring. We have the beginning of the bull market, which is the 3-year peak into the highs. During that first climb, Bitcoin went up 513%. We had the halving. Post-halving, Bitcoin gained 9,517%. This represented 98.96% of the total low to swing high price move occurred post-halving, 98.96%. If we move on to the next halving cycle, we see that 297.24% of the gain came from the end of winter, the beginning of spring. The beginning of that 3-year cycle from swing low to swing high was a 297.24% gain to the halving. Post-halving, the gain was 2,875.95%. This represented 97.44% of the total price move was post-halving. This represented 30% of the prior post-halving move of the prior cycle. Not so much a relative, I'm not sure how relevant this figure is. I think there's a little bit of interesting correlation with the following figure, but we're not really going to know if that's a relevant measurement until we see another completed cycle. But what is, I feel, relevant is the 90% plus gains post-halving, because we saw a much closer relationship here. We saw 98.96, 97.44. Now, in the next halving cycle, we saw 177.37% gain to the halving from the end of the prior winter. This was into the lows of December 18. And then after the halving, the post-halving move was 688.84%. This represented a 91.6% of the total price move was post-halving. So as you can see, that 90% gain of the entire swing low to swing high, the 3-year part of going up of our spring, summer and autumn seasons, the vast majority of the gain occurs post-halving. Now we can see here as well, in this cycle so far, we saw a 285% gain pre-halving. This is actually an extremely strong performance historically. This is almost on par with the pre-halving gain from the bottom of 2015 through to 16, and it is greater than the gain, the pre-halving gain that we saw of 177% from the lows of 2018 to the halving of May 2020. So this is actually a very strong performance, bringing us almost back to all-time highs. We had a long sustained correction after that. Now so far the gain afterwards represents the $63,958 move. The prior move was $44,227. This represents another 107% gain so far post-halving. The total value from swing low to what will be our swing high, we don't know where the high is yet because it's not in, but so far the post-halving move only represents 59% of the total price move from the end of the previous market bear market winter to the current highs. 59%, which is significantly below 91.6, significantly below 97.4, and significantly below 98.96. So what does this point to? Well, what this points to is that the vast majority of the gains are still yet to be made. Now we're running out of time from a time perspective, but when we look at the final move, which goes into these highs, the what can we call it? The parabolic, the parabola, the vertical move which comes out the other side of the curve, we can see that that is really hasn't happened. Okay, here it is again in the prior cycle. Okay, and here it is again in the prior cycle again. Right, this final vertical move hasn't really occurred. So it means that it's either about to occur and we're imminently going into crazy world, right? Which I'm totally down with believing is likely the case, and it's my primary count that explosive move is now to come, and we are going to see an incredibly explosive 8 weeks or so as we rocket higher. But it's also possible that it doesn't happen and the market peaks and this 4-year cycle and everything we know, or the regains we're used to making post-halving, I should say, are incorrect, or are no longer in this trend of being above 90%. You know, now they are reducing 91.6, 97, 98. Maybe this is going to be 80-something% or 70-something%. But if the trend was to continue in any sort of convincing manner, one would expect it to be above 59%, wouldn't they? So I do think it's interesting data. I look forward to updating it when this market completes and we crash into another bear market. We can update all of this data, we can update all of our cycle data, and we can reassess where we are in time and space, right? But in the meantime, I still feel that if that pattern holds, right, if the timing holds and the price action holds and the post-halving gains hold, then we've still got a lot of work to do. Okay, so now let's look at some classical analysis, shall we, before we move on to the Elliott wave section. So let's bring up our exponential moving averages on our weekly time frame. We can see here that we are above the 10, the 20, the 16, the 250. I do get asked why it is I use these and not a 10, 20, 50, 100, whatever, or 200. I guess it just hangs over from my trading days where I've spent most of my life, most of my trading life, mainly in equities markets, not here in crypto. And the reason I use the 10, 20, 16, 250 is, specifically the ones that people don't seem to understand are the 16 to 250, right? There are 60 trading days in a quarter. Okay, not days, as in the days you're alive, you wake up and go to sleep, trading days, because we don't trade at the weekend. I know you're about to say, yeah, but crypto does. You'd be surprised how accurate these things are, because I think after the vast majority of humanity who has been trading and investing over centuries now, the working week still takes precedent. And I'd argue a lot of people in the crypto space will agree. We always hear talk from crypto bros about the CME gap in the futures. So the working week still takes precedence. So there are 60 working days in a quarter. There are 250 trading days in a year. And that's why I use the EMAs set up the way I do. I find that in the equities market specifically, they have an extremely strong correlation with price. You go ahead and use simple 10, 20, 50, 100 if you want. That's totally up to you. But it's just a question which came up recently and I thought, fair enough, I've addressed it multiple times before, I'll address it again. Anyway, moving on. Let's now look at some of our indicators here. Now what I'm going to do is I'm going to come all the way out to the monthly time frame here, and I'm going to point out some interesting trends. So the monthly time frame, we're above the 10, the 20 and the 60 as well. If I actually didn't point out the significance of this, but the idea is basically that the smaller the moving average, the smaller the wave degree within Elliott wave maintains price above it. So we can see that on the smaller time frames we might come through the 10. On the smaller wave degree still we might stay above the 10, and we might come through the 20 on the larger wave degrees, and larger ones we might come through the 60, and larger ones still we might come through the 250. Okay, so they're basically a way of confirming larger wave degree corrections and smaller wave degree corrections. So if we take the same logic on the monthly time frame, we can move everything down a notch. So we can move the 250 to the 60, 60 to the 20, 20 to the 10, so on and so forth. And if we come out to our indicators for a moment, we can look at the RSI, and what I find is a little interesting pattern that I've noticed. I noticed this at the end of the last cycle, and back then we were talking about the potential oversold conditions we might reach, having seen this trend line be repeated multiple times throughout the history of Bitcoin, and we were talking about, well, we'll probably end up somewhere lower than this, lower than this, lower than this, right, if this trend continues. And that played out pretty accurately, and it was one of the things I was pointing to when we came into the lows of the last bear market, where I was saying, well, if we look at the monthly oversold conditions now within this trend and how far we've come back, we're very likely near the lows. One of the things we have yet to do this cycle is come back up to the overbought conditions, on this monthly time frame. We are just breaking out of this little downwards trend here, which has seen this bearish divergence between prior highs and current price. It is not bearish divergence if there is not a pivot in place. There is not a pivot in place, so don't read too much into the labeling here. It's just bearish divergence once there's a pivot in place. There isn't yet. It is simply currently bearish divergence between current price and prior highs in the RSI. So, if we are breaking out of this little downward trend now, we would very much like to clear, we'll say minor and major pivots. And what we'll do is we'll say we only want to see this on current interval only. We only want to see this on the current interval as well. It's only relevant to the monthly time frame. So this little arrow here. Right, so same with these green lines. Oops, I didn't mean to delete that. Same with this line here. And this line here. So this is just set up for monthly time frame. So we may do it, we may not. But it does kind of support the idea that the parabolic move of this cycle is yet to come. Okay, but the super breakout move is yet to come. Very difficult, I feel, for a lot of people to still be bullish at this point, but maybe it's just a bad habit of mine that I've been bullish the whole goddamn time, and I've been rewarded for being so. But maybe, you never know, a lot of people tend to get very bullish right at the last minute. Maybe they're not here yet, maybe they're on their way. Next thing I want to point out is in the prior cycle, I've been fighting this ever since we went through the previous highs of the prior cycle. I've had not constant doubters. That's fine. People can doubt, people can disagree. I welcome it. But I've had a lot of people saying, well, what if we just do the same? We do a double top, right? Like we did last cycle, where we have this high, then we do another high, and then we collapse, right? We don't have this parabolic move. That was a very strong sign. Hindsight is wonderful. 2020 hindsight, in the last cycle on the monthly time frame between the highs set in April of 21 and the highs made in November of 21, we saw very strong confirmed bearish divergence between prior highs and a pivot. Okay, there's no sign at all that this is the case from a momentum point of view on the MACD here. Average line is still expanding higher, signal line chasing it. So we are not showing up any bearish divergence in the MACD here. We are showing it up in the RSI on the monthly time frame, so they're not in sync with one another. Another thing I would like to point out is the difference in the bullish histogram, or the histogram of the prior cycles. Now we're going to have to stretch the chart a little bit, just so we can go back and point out the first cycle here, which was a peak into a trough. The next cycle was a peak into a trough. Okay, same thing again, right? The next cycle was a peak into a trough. This one's different. Okay, this time a peak into a temporary trough, into a lower peak, into a temporary trough, into a lower peak. This is not the same kind of thing we were doing before, right? Now, I'm going to stick my neck out here a bit. I'm not going to suggest that there's a relationship. There is no written word. There is no textbook pointing to the use of MACD and its support of Elliott wave theory. There is literally no connection whatsoever. So this is purely me speculating. So please be aware of that. Do not run away with this as a technical idea. It's just an observation of mine. Right? What if these smaller, lower readings in the histogram fit my primary count? This is one wave degree, this is another wave degree, super cycle, cycle, this is another primary, this is another intermediate, and the reason we're not going straight down is because now we go from intermediate to minor to minute to minuet, and this is actually all just a giant wave free extension, and that's why there's no divergence here supporting it. So it is different behaviour from prior markets. It's a much more consistent attempt to grow and to continue. It doesn't just go bubble crash, right? This time it's gone consistent gain higher, consolidation, consistent thrust higher, consolidation. And these could be the smaller wave degrees playing out. Just an idea, guys. So we'll move on from that. OBV. So this was brought to me a while ago when someone was saying, Tom, the unbalanced volume is not confirming higher highs in price. Yeah, it won't. If it does, it would be just about the most bullish thing imaginable. And maybe one day, I think in the future, it will. But for the meantime, we've been going sideways. Now, how is it that the prior cycle was lower than the one before it and this cycle is lower than the one before that? It's really simple. This is essentially a measurement of the cumulative volume. So basically the amount of trading which can be done of an asset in a single given time frame. This is monthly. Let me tell you, if you haven't figured it out already, it is a lot easier to buy and sell multiples of Bitcoin when it is priced at 2018 February pricing. It is a lot harder to move the same amount of volume, the same amount of Bitcoins, right? Actual physical, well, not physical, you know what I mean? Actual, if adding all the fractals together, every single fraction of Bitcoin, the total volume moved, it's going to be a lot harder to move the same volume when the price is now at March 2021 prices. And once again, it's going to be a lot harder to do that when the price is at August 25 prices. We're at 120k plus now. We are not going to move as much Bitcoin as we were when it was at the price of February 8, 2018. I don't even know what that was. I can't remember. Should we put a line on the chart? Let's remind ourselves. Right. So price here on this week was 10 grand. Right. We're 10 times, more than 10 times higher now. And yet I would argue, even though we're 10 times higher in price, right, we're still very strong in our unbalanced volume overall, right? But if we were, for whatever reason, in future cycles, maybe we're about to correct again, right? If the timing is correct, the 4-year cycle holds. If it holds, and we're about to correct again, then maybe in a future cycle we'll break through one of these highs. Now, I'd argue when we're getting Bitcoin back above 100k, maybe above 250,000, if we're moving that kind of volume, then everyone who can be in is almost getting in by that point, right? But I would expect it to probably continue this trend. If it were to break out, though, that would be just stupendously bullish. That means mass adoption on a scale that we can't even... I mean, I was about to say that we can't imagine. That's not fair, is it? Because just a few years ago, we couldn't imagine institutional adoption. We couldn't imagine ETFs. Everybody was talking about it like pie in the sky stuff. And yet we're here, right? So maybe, government adoption, central bank adoption, every goes into everyone's pension, everyone's 401k in the States, everyone's savings accounts, you know, whatever. Anything's possible if enough of the general public get here. Either way, I think that concludes our classical analysis, so now let's get on with the Elliott wave section. Right, so here we are looking at the Elliott wave count over the long term on the BLX. So, as I said, the 2013 to 15 was supercycle bear market, supercycle degree 1, 2. The 17 to 18 bear market was cycle degree 1, 2. And the 21 to 22 bear market was primary degree 1, 2. I've pointed, if you go back to a video, the primary Bitcoin primer, go back and watch that. I go into detail as to explaining how I've measured all of this, the conclusions I've come to, why I've done it. I cover things like the depth of the corrections and the corrective form, how these are all sharp patterns and not sideways structures, how there doesn't appear to be any alternation between wave degrees, how the size and scale of each correction shrinks in either time or price, stays consistent in time most of the time admittedly, but decreases in price. The decrease in the severity of the decline combined with the repetition of the waveform suggests that they are all the same type of correction, sharps, and therefore most probably twos given the depth of them being over 60, 70, 80%, right? But the fact that they're shrinking in severity suggests that they are smaller wave degrees. And that's the conclusion we use from an Elliott wave basis, or I've used from an Elliott wave basis. So from that point we go into the smaller wave degrees. And we see intermediate 1 into 2, minor 1 into 2, minute 1 into 2, and minuet 1 into 2. This suggesting that we are, as we move along this pivot, this pitchfork, based from the bottom of cycle 2, the beginning of primary 1, to the swing higher primary 1 to the swing higher primary 2, this now creates the trend for the subsequent smaller wave degrees. And as you see, if we were to just let's just delete these little brush marks I've made, you can see, let's turn off the moving averages because they get in the way. We come up, we come back to trend, we find a low, we bounce. We come up, we come back to trend, we find a low, we bounce. We come up, we come back to trend, we find a low, we bounce, right? This is the trend that this prior pivot is set in terms of our destination, in terms of our projection. So where we go from here, well, use of the pitchfork suggests that the first stop we make at the same wave degree, so this is primary wave degree, so this is 1, this is 2, at the same wave degree, the first stop we'll make is the median line, right, as a potential target. It could be higher, it could be the top of the pitchfork itself, right, but primary wave degree has a roughly an 80% chance of finishing around the median line, right? So this is likely why we keep doing this, because we're trying to get to here. Okay, now there is within an extension the possibility that the smaller wave degree has not completed and we fall out of the larger wave degree pitchfork. On my Patreon, on my Discord, I cover this in Elliott wave theory. I cover this in my video about extensions. Extensions have a habit of breaking the base structure of these larger wave degrees. So we go 1, 2, 1, 2, 1, 2, and we break the bottom of the pitchfork, and then we race to get back into it. It's a feature of wave-free extensions. That's going to be a possibility as well, so we'll talk about that. But in the meantime, the trend is your friend. We make higher highs, higher lows. We're consistently bouncing off of that support and moving higher. So we're going to continue to mark each subsequent smaller correction as a smaller wave degree, just as we've been doing on the longer term. Now there are alternatives, so we'll cover those now. So the first idea is a wave 5 extension. So we've done 1 and 2, 3 and 4 instead of 1, 2, 1, 2. And now this is 1, 2, 3, 4, 5, and we're going to have the parabola move here within the 5th wave to complete the 3. Now the reason I don't tend to talk about this much is it doesn't matter. I was about to swear. It just doesn't matter. Right? Because whether you're going 1, 2, 1, 2, 1, 2 in the 5th, or whether you're going 1, 2, 1, 2, 1, 2 in the 3, the returns for the next few weeks / month or two is going to be absolutely crazy. So it just doesn't matter. We'll worry about that when we get towards when we're so high up that we're freaking out. Okay, we'll worry about that then. So the ones that I do think do matter are these ideas. This is a bearish idea that intermediate 1 is here. This is 1 and 2 at primary, as we saw 1, 2 at cycle. We've gone 1, 2, 3, 4, 5 into intermediate 1. This is A down, this is B up, in a B wave for a flat, and this will be 5 down in a C, bringing us likely back into all this tradable volume here and the prior all-time highs of the prior cycle. This could see price come below 60,000. Right, it could even come deeper. Now, this is a possibility because it breaks that pitchfork we spoke about. See, and it fulfills that behavior we sometimes see in an extension where we break that supported pitchfork to find another lower wave 2 before racing back in. So there's a possibility we'll be keeping an eye on. Now, what this would suggest is that yes, the cycle continued to new highs, okay, and it roughly did finish where we would expect it to finish, okay, around October, because it could continue a bit higher yet, but the actual market finished its 5-wave up move, its impulsive move, back in January of this year, and everything since has just been corrective. Now, obviously, dominant high, dominant low doesn't care about Elliott waves, so it doesn't care that this was a corrected B wave. The result's the same. We go up to another high, we come crashing to a lower low. This is a possibility, but this is not a possibility once we get above £130,000. Dollars, I wish pounds, sorry, a bit greedy. Wishing above £130,000. Dollars, Thomas, sorry. God, the white pounds and pence are on my brain today. I am British, but normally I work in dollars all the time. Either way, 130k dollars. Get above there, and the B wave is beyond the 1618 extension, which is the cutoff for an expansive B wave with an expanding flat structure in Elliott wave. Right? It's obviously impulsive beyond that point. Okay, but it's still alive and well for the moment. Next alternate is this. Okay, we're going to come back out into log. This is the idea that intermediate 1 was not back here, right, or was not here. It is here, and it's going to happen imminently. So in this count, we've gone 1, 2, 3, 4. This is 5, and it's an ending diagonal. Right. A structure of overlapping, contracting wedge waves which form a rising wedge. Has to divide as zigzags. We'll talk about how in a little while. But either way, we top out on an intermediate 1, big nasty correction into a 2. Okay, this is a possibility. This would likely confirm the continuation of the full year cycle, because this top's going to come in within the next few weeks. It could be in today, could be in tomorrow, who knows. But this supports the idea of this just being a 5-way structure. So at that point, we would end up with 1, 2, 1, 2, 1, 2, 1, 2. Again, intermediate, primary, cycle, super cycle. Now, a lot of people might be crying, going, oh God, I hope this isn't true. I am secretly praying this is true. Now, don't get me wrong. My bullish count's awesome. Everyone's going to have a party time and we're off to the moon forever, right? But if my bullish count is correct, you will never, ever get another significant discount in Bitcoin the likes of this. Nothing like this will ever happen again. Okay? Just be aware of that. But if this is right, you'll get to buy Bitcoin 50% off again or better. Who can possibly turn their nose up at that? Right? All you got to do is trade some time. Some time for some pretty obscene wealth possible opportunity. Right? So don't beat yourself up. If this turns out to be right, embrace it. Wonderful opportunity. If you've missed this for whatever reason, maybe you've only just become aware of Bitcoin for the first time in your life. Maybe you're an idiot who's been fighting it the whole time. Anything's possible, right? But if this is the opportunity that comes again, you should embrace it. Right. So they're the longer term patterns. We're now going to come down and focus on the shorter term. Okay, so here we are on the smaller time frame on the day chart, looking at the primary count. So I've spoken about the 1, 2, 1, 2, 1, 2 and all the various ideas of getting up to the current highs. So now we're just going to zoom in on the shorter term. Okay, things get messy here, guys. It's just an unfortunate side effect of the chart being as busy as it is. When we're down to these smaller wave degrees, the volatility, the speed at which things change is pretty impressive. So let me clue you in as to where we're looking at in the most recent correction. So the high of January 25 into the low of April 25. This is when the stock market corrected. This was a minute 1 into 2. Minute wave 2 completed back here. Remember, we've gone supercycle, cycle, primary, intermediate, minor, and now this was the minute wave 2. Since then, we've done minuet wave 2. Here's the 1 ending in May. Here's the 2 ending in June. Since then, we've done subminuet wave 1 into 2. Okay, and this was the high of July into the low of August. Now, what do you notice about all of these corrections? Shall we take a look? Here they are in length. And what do we notice? Minor wave degree was 144 days in length. Minute wave degree was 77 days in length. Right? Minuet wave degree was 31 days in length. Subminuet degree was 19 days in length. I've been here before. This is my third rodeo, remember? And as we were progressing into the parabolic move, which exploded into the highs of the prior cycles, we went from corrections lasting, on the longest term, obviously years, into months, then into weeks, then into days, then into hours, and finally into minutes. And unless you've been through it, you won't believe what I'm talking about. But eventually, these smaller waves break down into such small degrees that the chart is basically vertical. At the moment, everything is progressing as expected. Each subsequent correction is getting smaller. Now that leaves us with the primary count of ever shrinking wave 2s, but it also leaves us with the contracting diagonal, and that we're about to peak and roll over. They are both similar structures in how they behave. But I'm going to talk to you, but like I said, we stick with the trend. The trend is your friend. We're making higher highs and higher lows. And the primary has a lot of support. We've spoken about in other videos of the Bitcoin primer. We've spoken about just now with the classical analysis over the longer term. There's a lot of reason to believe this is correct. So we're going to stick with it until it breaks. And if it breaks, so be it. But in the shortest time frame, let's now zero in on the shortest time frame. So coming up from June 25 to the peak of July 25, we had another correction. We came back in a 3-wave zigzag, what is known as a sharp. We had an A down, a B as a running triangle, where the A goes up within the prior internal correction, the B extends out external to the prior correction, C returns within, D within the B, E within the C. We then come down, completing a nice channel 1-to-1 correction. A is equal to C projected from B, 1-to-1 within a corrective channel. Sweet, right? Textbook Elliott wave stuff, right? Just looking really neat. From there, we've come up in a couple of different ways of interpreting the most recent move up. So let's come all the way down to the 1 hour now. Now let's remove some of this data here. It's a little too messy now. And let's just focus in on this recent move. So, how can we look at this? Well, we can look at this as the white count. Let's look at that first. 1 into 2, 3 into 4. Subdividing as 1 into 2, 3 into 4 into 5. And now we're doing a wave 4 here as maybe another zigzag, and then we're going to climb back up. So this wave 4 is retreating into this prior wave 4, very common Elliott wave behavior. And then we're going to push up into a wave 5, and then we're going to find the top of micro 1, and then we're going to start another one of these, you know, another one of these wave 2s, right? But the next one will be smaller than this one. Remember, months into weeks, weeks into days, days into hours, so on and so forth. So the corrections are not going to stop coming, guys, until they stop coming. So don't despair over them. They are the final opportunities before liftoff. Unfortunately, people will get chewed up by them because, you know, people are people. Now, on the other side of this idea is that we've had 1, this is the orange count, 2, 3, 4, 5, and this is micro 1 complete. Here, and we are now coming down in 5, 3, 5. Okay, and we'll be looking for a wave 2 target retracement anywhere between the 50 and the 89%. I say first target is the golden zone, 50 to 61.8. Right, this is our target box. I don't know which one it is yet. Okay, I would not expect the wave 4 at the smaller wave degree to come back below the 4 of a larger wave degree. Okay, and it can't transgress within the wave 1. But if it did that, it'd have to come back below the target zone anyway. So we might as well just look at 50 to 61.8 as a pullback zone. Okay, for this swing high into a swing low before moving higher again. So I'm not sure which one it is, but we've either topped in a wave 3, 4 to go higher again, or we've topped in a micro wave 1, which is one wave lower than sub-minuet back here, which resulted in this correction. So we can expect another time-consuming correction. Well, if you consider a handful of days time-consuming, it's really not. But you take my point, a bigger correction. And then we swing higher again. That is the primary count. And that is where we are on the primary count. Now, in the alternate count, we've got this, let's put these away into the primary folder, like that. Now here's the alternate count with the idea that we're finishing a ending diagonal. Right, we're going to zoom out here. So we did 1 into 2, A, B, C into 3, into 4, into 5. We can actually add a little bit more detail here. Doesn't really matter how we do that. A, B, C, 5, 3, 5, and now we've got this final move up into the 5th, which could be in now, right? Or it could be in a few days, or maybe even a few weeks, maybe in another month. Depends how big this zigzag's going to be and how much it's going to throw over the top of the trend line. It could do something like this. And where's that taking us? That's taking us out into the end of the month, end of next month, right? It could even come to the October target. I have no idea, right? We'll have to wait and see. What I do know is that the primary count invalidates the previous low of August. So what we'll add, just to be sure, put that in the alternate, bring the primary count back up, and we'll add in an invalidation point at the prior low. I know the chart's really busy, and I know it's not ideal for for giving you guys information on YouTube, but this is a functional working chart that I'm using for my analysis, for me, and for my business. So at the end of the day, it has to be a functionable, usable chart. So there's our invalidation point, 111,919. If the primary count of subsequent 1s and 2s is correct, right, we will not come below here. An alternative idea, and we'll only deal with that if we come through the invalidation point, would be that this 3-wave move was followed by a 3-wave move, which was followed by a 5-wave move, which took us into a flat. We'll worry about that if we come through 111,919. If we don't, we haven't got any worries. Alright? If we come through 11,199, then, or whatever it is, 919, then it could possibly be this, and it's topped. In which case, we are already in a new bear market, and we've got a long way down. Right. Now, why aren't you choosing this, Tom, over your primary? I'll tell you why. Is an ending diagonal must subdivide into zigzags. Now, they can be multiple zigzags, which is a multiple zigzag pattern, be 2 or 3, is still a zigzag. Okay? It can never be a motive structure. It is a corrective structure, and it subdivides into 5, 3, 5s. It just does it more than once. But they're all zigzags. The only way to get this to subdivide cleanly, right, preferably a single individual zigzags for an ending diagonal, is to go A, B, C, which is a little ridiculous. Now, why does it look ridiculous? It looks ridiculous because this is clearly 1, 2, 1, 2, 1, 2, 1, 2 overlapping. Breakaway 3, 3, 4, 3, 4, 3, 4, 5. This bit here is the 3 of the 3, the clear break of the structure we have here of overlapping, and the structure we have here of overlapping is divided by the 3 of the 3, which is a straight line up. That's a wave 3 extension. This does not resemble a zigzag at all, because we either do it here, which is kind of ridiculous, or we do it here, which is kind of ridiculous. This is clearly 5 waves, and we can't have 5 waves in an ending diagonal, only in an impulse or a leading diagonal, and this is the last wave. So it can't possibly be If it's 5, an ending diagonal, and therefore I have to downgrade this as less probable, because that's a better 5 than it is a zigzag, and therefore it's a better fit for the primary count than it is for the alternate count. Right, what if all that's wrong and we're working on that bearish idea, right, that we peaked back in January, we came down in an A, we're coming up in a B, which could be in the target, which we're in the target box for now, and we come down in a C. Well, we covered this in the longer term count already earlier, right? This is a fake out high, dominant high admittedly in price, but a corrective wave in Elliott wave, and what we're actually getting is a free wave move, maybe a double zigzag, W to here, X, Y to here perhaps, to get our B, and then we come down in 5 waves in the C. Once again, the first clue we're going to have that we've either topped, right, in this bearish structure or topped in the zigzag to come is that we break the recent lows. If we break those recent lows, this either becomes a larger wave corrective count, right, or it's the bearish structures, either this one or the completed ending diagonal. So we've got it all to play for at the moment. But that is, let's do a summing up, shall we? Primary count. The trend continues. Higher highs, higher lows. Right? And it continues to play out from monthly to weekly to daily to hourly, so on and so forth. Right? We've recently just made another all-time high. So for the meantime, we're in a bullish trend of higher highs and higher lows at smaller wave degrees. If we come through 111,919, this is no longer true. That's our first port of call to get suspicious. This is why we move the invalidation points up. This is why you move your stops up over time as you are exposed to a long-term trade, so that you get out at a profit. Right, this is part of risk management, which is another thing I cover on the Patreon. But either way, that's the primary count. Alternate, my favourite alternate, is that we're in an ending diagonal and it could be over any freaking moment, because we're now clear of the wave 3. The 5's now come above the 3, which means it can end at any time. Right, first clue will be coming back for the pivot at 111,919. Then we've got the bearish idea, which is basically the same. We're already in a correction. It's been going on since January. Alright then guys, I think we're going to leave that there. So if you're new to the channel and you like what you've seen, please smash the like, hit the little bell notification icon to remain informed of future video releases. And if you want to learn all this stuff for yourself, Elliott wave, technical analysis, some trading as well, and the rest of it, then feel free to sign up to my Patreon. It's only 10 quid a month and you can leave it any time you like. There's a big public Discord with lots of members on that you can join and learn from. Lots of educational materials about Elliott wave and other things as well, such as risk management and trading in general. Feel free to sign up. You can leave it any time you want. You can upgrade to the tier 3 package of £15 a month, which gets you a little bit more. But you go and look at it yourself if you're interested. I'm not going to hard sell you it. The link's in the description box below. If you're interested, feel free to sign up. And take care of yourselves, guys. I'll be back with you as soon as I can. All the best. Bye bye.